Hello, Pam DuBois, DMV Real Estate, DC, Maryland, and Virginia. So excited and happy that you've joined us again today. Today I have with me Steve Yeager from Prime Lending, and we're going to be talking about loans, interest rates, different programs that's out there. First, Steve, tell us a little bit about yourself and how you got started in the business.
I've been in the mortgage business 35 years.
Okay,
and
that's a long time.
And I'm still learning.
Yeah.
Yeah, and I came into the business. I studied marketing and finance at the University of Maryland.
Okay.
And came into the business. I was working for Merrill Lynch Mortgage Corporation, and I was trying
Way back when. Yeah.
I was trying to get into the industry, and it was tough. You know, nobody wants to give you a chance.
Right.
So
yeah.
I ended up working on a trial basis for 30 days with no pay as an entry-level loan processor.
Oh wow.
Yeah.
Okay.
And then 2 weeks into that 30-day period, they offered me a paying position at $15,500 a year.
Okay. What year was that?
That was 1983.
Okay. Wow.
So the year I graduated from University of Maryland.
Okay.
So that's how I got into the business.
I guess back then 15,000 was a good income.
Well, it was any
It
way
was okay.
to get your feet wet.
Yeah.
Into the I started out wanting to be a stockbroker, but didn't really pan out. So I got into mortgages, and I'm really glad I did.
Okay. Okay. So then you went from Merrill Lynch to, how long did you stay with them?
Just about a year.
Okay.
And then from there I went to a company called Travelers Mortgage.
Okay, I remember Travelers
Yeah.
Mortgage.
And then from there it was National City.
National City, I remember
Yeah,
National City,
and
yeah.
I was there like
That ages us, right? Back then.
Yeah, I was there like 17 years, and then
Yeah.
PNC bought National City, and
Yeah.
I was at PNC for a couple of years. It's also a good company, and then for the last 7 years I've been at Prime Lending.
Okay. Okay, so you've been there for a while now. That's good.
Yeah.
Treating you good. That's awesome.
It's great. I'm really happy. Yeah.
Okay. So the interest rates are low right now. How are you doing? I mean, are you crazy busy right now?
Yeah, we are busy. When rates come down, people line up because they want the lowest rate. But it's interesting that when rates go up,
yeah,
people break the door down because
they're all flooding to you, right?
They don't want to pay any higher
rates.
rates.
It, yeah.
But rates are one factor in the whole process,
Mm-hmm.
and there's some talk about where the economy is going,
Mm-hmm.
and there's different ways that we evaluate where the economy is going. Right now, we look at the bond market,
Okay.
and the bond market is such that the 30-year bond is trading lower than the 1-year Treasury Security Index, and that's described as an inverted yield curve, which typically is followed by even lower interest rates. So we're pretty optimistic about the next year or two about where rates are going.
Really?
Yeah.
So you have a lot of people sitting on the fence right now. Is that the case? People are just waiting for it to go lower, even lower?
Well, rates are just one part of the process.
Yeah.
We actually do more purchases than we do refinances.
Okay.
And I always like to ask people, if you were a lender and you were going to do one more loan for the month, and if it was a refinance or if it was a purchase, which would you do and why?
Okay.
So I'm asking you the question now.
I would know which basically, because as far as the purchase market, people are always going to be purchasing, and then you have all the realtors that are part of your actual clientele, right?
Yeah. Well, the answer is a purchase. We would choose to do the purchase because with a purchase there's an emotional commitment to the next phase of the financing. There's they've looked at the schools. They're committed to a greater standard of living, and there's a realtor or two realtors involved in the process.
Right.
It's whereas when you're refinancing, you're to some extent you're just dialing for dollars, and we do quite a few refinances, but it's a different emotional outlook on the process. So we do refinances, but we really watch out for a purchase business.
Right. Well, the purchase business, people are always going to be purchasing, and then when your realtors, you have your realtors basically on both ends, selling and the listing end, basically. So those are people that bread and butter, basically, right?
That's true.
Bread and butter.
They depend on us, and they should. And when it comes to that closing date, by golly, you got to meet it, or you're only as good as your last loan.
Right. Why do realtors do that? We're just, it's just that way. I don't know why.
Everybody's in the hot seat,
Mm-hmm.
and we all have to perform. And,
right.
And you get used to being out of your comfort zone.
Right.
And we have a tendency to just be there and make it happen.
Yeah.
We have to. Everyone's depending on us.
Yeah.
So we enjoy that. We enjoy that you tend to thrive on the pressure.
Right.
And it's no pressure anymore because it's just the norm.
Right.
We're just used to it.
We enjoy that stress from through the process, and then at the end, it's like, oh no, it's gone. Where's the next one? Right.
We wouldn't have it any other way.
Yeah, it's exciting. Special programs for first-time homebuyers.
There's some really good stuff out there. There's Fannie Mae and Freddie Mac, and they typically have your 3% down deals where you take a homebuyer education course.
Mm-hmm.
There's some state of Maryland programs where they'll give you an interest-free loan for the down payment and the closing costs.
Okay.
And then different jurisdictions have programs set up for down payment assistance.
Okay.
So they're all kind of similar in terms that you have to pay take a homebuyer education course,
Mm-hmm.
and the guidelines are a little more strict because when you get something for free, you normally have to give up something, like you can never rent out the property or you have to refinance it in order to rent it out, and in some cases the sales price is subsidized. So if you want to sell it, they tell you what to sell it for if it's an MPDU type of thing. So.
Right, I do remember that.
So we have those programs, but
Mm-hmm.
they're not always all they're cracked up to be because there are some restrictions. So if they don't have the resources to buy a
Mm-hmm.
home, we certainly bring that up. But if they do have the
Right.
resources, there are some as attractive or even more attractive programs for first-time homebuyers.
Okay.
Yeah.
Now that as far as the down payment programs, I guess basically is that they have to pay it back, or what? I guess, or how does that work if they're selling?
It's normally an interest-free loan,
Okay.
and they pay it back when they sell the property.
Okay. Okay. Yeah, I haven't heard the word MPDU in a long time. Are those still around?
There's a few of them.
Okay.
There's a lottery,
Okay.
and they get one heck of a deal on the price, and they usually get special terms on the financing too.
Right.
But we do occasionally we'll do an MPDU.
Yeah. For those of you that don't know, MPDU is a Montgomery County program for first-time home buyers, and I think it's about 5% that the builders are supposed to actually allow for, low income. You have to qualify for the actual and put your name, I guess, in the whatever the process basally to get chosen. Is that how it works?
The lottery, yeah.
The lottery, yeah. It's been a long time since I've actually, heard that word. Low down payment programs.
Well,
just FHA, conventional.
Those are pretty much the low down payment programs, the 3% down. There are some 100% financing programs out there, but
that's good to know.
Yeah, but those kind of got the industry into trouble a few years ago. So we're really not doing much of that.
You're not?
No.
Okay.
I mean, I think we have a program, but the rates are high and the qualifying guidelines are more strict, and it's I think it's better off for the industry to have a little bit of savings.
Yeah.
Put down a small down payment, go with a FHA or Fannie Mae typical. There's a Home Ready program.
What's that? Home Ready program?
Home Ready, that's a Fannie Mae program.
Okay.
That has 3% down. You take a home buyer education course, and you get reduced mortgage insurance.
Okay.
Which is really, really attractive.
That's good, yeah.
And if you get the seller to pay the closing costs, you can get reduced mortgage insurance, and there's a program where you can pay the mortgage insurance on a one-time basis. It's called single premium mortgage insurance.
Okay.
So that you don't have any mortgage insurance for the life of the loan.
At all? Wow.
There are different ways to structure the deal.
Yeah. That's good to know.
Yeah.
That's good information. Yeah.
Well, a mortgage insurance with a small down payment and a medium score to a higher score, it's still very expensive. So if you can buy it out up front.
Yeah.
It's a huge savings for people.
Right.
Huge savings.
Oh, that's great. That's actually great. Yeah. Now you mentioned scoring. Tell us about credit scoring and where that puts us as far as interest rates and the actual rates, because a lot of times I think that can dictate what interest rate you get, right?
True. Well, the whole industry is credit score driven.
Yeah.
Our lives are credit score driven. You got health
It's
insurance,
true.
job interviews, security clearances. It's all about the credit score.
Everything is about it.
And we do some credit rescoring.
Okay.
Where someone will come in, they want to get pre-approved,
Mm-hmm.
and we'll start the process. We'll get their pay stubs and bank statements and W-2s,
Okay.
and they'll have a good credit score, but it's never good enough.
Really? Yeah.
I mean, people always want to have a higher credit score.
Right.
So what we do is we can, while we're verifying the income and
Mhm.
getting them pre-approved, we can suggest, well, why don't you pay off this bill, or why don't you open up maybe you need more data to go to Equifax, Experian, and TransUnion, so you can build your score up a little bit.
Yeah.
And while they're shopping for a home, they come up with a certain score, and then by the time that they're ready to submit the loan for approval or get the contract ratified or even go to closing, if they get a 20-point bump in the score, we lower the rate.
Oh, that's great.
Just like
Yeah.
that. Yeah,
That's good
it's
to
very
know.
easy to do that.
Okay.
So it's all part of the
Does that take about a month to do something like that?
Yeah, it could even be sooner if they have the resources to pay down a revolving credit card.
Mhm.
And we can do a credit rescore in about 5 to 7 days, where it used to take 60 to 90 days.
Wow,
We can
that's
do
really
it.
good.
It's called a rapid rescore, and we don't even charge people to do that.
Really?
We're not allowed to charge people to do that. So
No, you're not.
we don't do a whole lot of credit rescoring,
Yeah.
but when it's applicable, we do bring it up.
Okay. Wow, that's really good to know.
Yeah, it's an exciting industry.
It is an
It's
exciting industry.
emotional, helping people achieve a greater standard of living, and it's not an easy process. If it
No.
was an easy process, they would go online and they wouldn't call you and they wouldn't call me.
Yeah.
And we don't have all the answers, but we have to figure out the best route to
Yeah,
go
yeah.
each and every time.
Yeah. So you love your job. That's awesome. It's always great to be able to find someone that just is so much into it, and you are. That's
We
great.
enjoy it.
Yeah.
We really enjoy it. It's challenging. Never the same day twice. Never.
Never the same, yeah. No transactions ever the same. Always, something. So pre-qualification process, basically. Tell us a little bit about that and how long it would take.
Well, there's a couple ways to do it. Some people just do it online and they upload the documents
Mhm.
securely. Other people want to come in and talk about the different programs.
Yeah.
Most people want to know how much they qualify for, what the high end they can qualify for.
Right. Do you do both? Do you actually online and also sit down with the clients
We
also?
do.
Okay,
We
that's
do.
good. Okay.
The pre-approval process is crucial
Mhm.
because of course the seller wants to know what the likelihood is that someone's going to get approved and go to closing. And
Yeah.
what we do is there's an automated underwriting system.
Okay, that's what I was going to ask you. Yeah.
And it's
Okay.
called Desktop Underwriter
Okay.
or Loan Prospector, and we collect all the income and asset documents, and we do
Mhm.
all the data entry, and we run the automated underwriting system, and if we get an approved eligible,
They're good to go.
The loan is pretty much
Yeah.
approved. We verify the integrity of the data. That's our
Mhm.
responsibility,
Yeah.
and we do that on a regular basis. And then they're out shopping for a home.
Yeah, they're ready to go, and the only thing you really have to do is, I guess, just update the pay stubs, the current pay stubs, and the bank statements
Yeah.
later on, depending on how long it takes them to find the home. So, yeah.
Yeah.
Wow, that's great. How about programs to sellers, like bridge loans, sellers that are actually looking for a home and they're in their current homes? Do you have anything that actually ties in as far as the bridge loans? You know what I'm saying? Yeah.
We don't do too much bridge
Bridge
loans,
loans,
to be honest
okay.
with you. There is a program for sellers that need their property fixed up,
Mm-hmm.
and what they can do is they can apply for the financing to have enough funds to do the home improvements,
Okay.
and then they would hire a contractor, and we would get the contractor approved, and then they would have enough funds, to upgrade the property in case it wasn't, showing the way they want it to.
Oh, okay. So something basically they didn't, like if they don't have the funds, just basically work to get done before they actually put the home on the market.
That's right.
Okay, like an equity loan, basically.
It could be a home equity loan, or it could be a renovation loan.
Okay.
There's a couple different ways to do it.
Okay. So you said renovation, so that takes me into the renovation financing and talking a little bit about that.
Well, renovation financing is big today. People want to. There's a lot of anybody who's watching HGTV
Right.
is sort of fantasizing about flipping that house, or but when you're using renovation financing, it's not only to flip a home, but it could be to occupy a property. It could be to purchase a second home or an investor home. There's when you think about renovation financing, the first thing that comes up is 203K financing.
Right.
Everybody knows about 203K, but what they don't know about is that there's a whole menu of choices for conventional financing.
Okay.
Where FHA for the 203K is 3.5% down, but there's a conventional product that's for renovation financing that's only 3% down.
Oh wow.
A lot of people don't know about that.
They don't know about that. Yeah. So that's good.
And the thing about the renovation financing is, it's tough to buy a house. There's a lot of competition, and the houses that are the turnkey, ready to move in properties, those you're gonna have to pay the list price or above the list price. There's a lot of competition.
Market's hot.
And people don't want to do that. They want a deal. They want seller help. They want to come in a little bit lower on the price. And if you find a property that needs a little bit of work, and you're willing to have vision about how you want it to what the final product is going to look like, you can get a super deal and roll in your granite counters and your ceramic tile floors and your stainless steel appliances, and you can get it all with 3% down, or you can put down more. But Fannie Mae does allow a 3% down renovation product for a first-time home buyer.
Wow, that's a great product.
And in DC, the loan amounts are high enough where you can get a pretty nice home. DC, Maryland, or Virginia.
Yeah, we were talking a little bit about, I guess as buyers are looking for homes that are actually, that's maybe it's been on the market a little bit longer when they're doing their search, as opposed to the ones that, like it comes on the market and it goes by quickly for your renovation loans. If they're homes that it's sitting on the market, if they're sitting on the market for a reason, or there's a reason why they're not selling. And that could be one of the reasons, is it needs work, and buyers don't want to do any work.
It's true.
Yeah.
I'm actually working with a seller right now, where they have a home in a new subdivision where they're still building, so there's a lot of competition.
Yeah.
And their house is absolutely gorgeous. There's nothing wrong with their property, but it's been on the market for a long time.
Okay.
And they just haven't seemed to have been able to get it to sell or get enough interest in the property. So what I suggested they do is create an artist's rendering of the installation of double French doors that go out to a white Trex deck.
Okay.
And it's just like going into a home, a new home subdivision, and you can pick your brand new options, but here it's a resale and you can still pick a brand new option, and we're going to use the renovation loan to finance that $20,000 option.
Okay.
And they'll be able to differentiate their house from even the brand new constructed homes that don't offer that. So we're leveling the playing field.
Yeah, that's a great program. Now, how do you go about doing that?
Well, we have some relationship with home improvement contractors, and they have these software programs that do the design online, and we just take a photograph of what the house looks like now, the room looks like now, and then we say, well, we want to put this addition on, and we want it to be how many square feet, and then they'll just do the artist's rendering, and we'll put it up on an easel, and when people walk through in the open house, and they're like, because when it comes to selling a house, if you think about every house that you've ever bought, there's something about that house that you really like. There's one thing. It's like an anchors.
Yeah.
It's like a Apple store in a shopping mall. There's something that they really like, that they really want about that house.
Yeah.
And if they can have that deck that with the double French doors that go out that nobody else has, that's going to get them to start talking about writing a contract. That's what we want to do.
That's a great marketing tool. That is really good. Wow. So you're doing that now with homes that are out there?
We are.
Yeah.
We are.
That's actually an excellent idea. I mean, really, not many people are even thinking about or doing that right now, right?
Well, there's a lot of competition out there.
Yeah.
Especially in the in the upper price ranges. there's a tendency for people to, there's your 3-bedroom, 2.5-bath standard property, and so it might take longer for some of the bigger homes to sell. It's just that more marketing time. I mean, look at what HGTV is doing now. They have a segment where they're renovating homes for single parents.
Really?
That want smaller domiciles, and
Okay.
then there's another push for properties where you're having an accessory apartment in the basement,
Okay.
where you can generate rental income. There's this whole Airbnb thing going on.
That's going on right now. Yeah.
That's totally
Yeah.
huge, and you can sell your home with the plan to have an accessory apartment in the basement and build it all into the financing.
Yeah.
And then you can get $1,000 or $1,200 a month, and that can really make your mortgage payment a lot
It's
easier.
income making. Yeah.
So there's just
Well, how does that work from a lender's point of view? I mean, looking at that,
well,
right?
it's perfectly okay.
It is okay?
We can do up to 4 units,
Okay.
and it's a little bit easier if it's a primary residence.
Okay.
Because the amount of equity you have to have in the home is less. You can
Okay.
have 96.5% equity in the home,
Okay.
and convert your basement to an accessory apartment.
Okay. So that's important. You have to have equity in the in a home. Yeah.
A little bit of equity, not a lot of
Not a
equity.
lot of equity.
Some people think you have to have a lot of equity, but you don't.
Yeah.
You don't.
I would think you would have to have a lot of equity, but you guys allow that with a little equity. That's really good.
Anywhere from 3 to 5% for a primary residence. If it's a second home, or if it's an investor property, it's 10 to 25%.
Okay, that's pretty good.
But that's
pretty good.
Pretty reasonable for those kinds of properties.
Okay.
Yeah.
Okay. Talk to us a little bit about interest rates and why a lot of times you'll get somebody to call you up on the phone and they'll want to find out what your interest rate is and the reason why you can't quote them an interest rate on the phone without finding out more about their situation, their overall situation.
Well, we get that comes up all the time, and rates are really important. But typically, what we'll do is we have to ask the right questions, and we know that when people are calling us about potential financing, we're not the only person they're calling.
Right, they're calling around.
Right. And that's okay because they have to feel comfortable with their final decision. So what we try to do is we try to get them to compare apples to apples.
Yeah.
There are we do loans for primary, second homes and investor properties, and I have several repeat customers that want to come back into the marketplace and they want to get into this real estate boom where they want to have a real estate portfolio. They're seeing around the neighborhood, I want to pay cash for your property, or they get mailings that I want to buy your home, and so they want a little piece of that.
Yeah.
So
that's all over the place right now.
I have some great customers that want to do that, and I send them an estimate of closing costs, and the rate was, they see 4.5% or 4.25%, and they're like, and the rate for an investor property is higher than that, and they're like, well, what's going on? Why can't I get that? And I had to explain to them, and that they're buying an investor property, and if it's a renovation loan, it's still a little bit higher, but if you think the whole thing is about having vision about the process, because when you buy the house and it's under market, but you're paying a higher interest rate, and when the work is done, you're going to have, instead of putting down 5%, you're going to have instant equity. Hopefully, you've gotten a good deal. You've shopped your contractors, and you're going to have equity built up in the property. And once the work is done, what's the first thing you do once you've got that newly found equity?
Right.
You're going to refinance, and then you're going to lower the rate back to the market rate.
Yeah.
And you're going to wonder, when can you do it again?
Right. Now, why can't I have 2 principal residences?
Primarily because when you file your taxes,
you
have to designate to the IRS which
one is
your
actually
primary residence.
Yeah. So basically, I know, like, if you buy investment properties, or like, let's say you bought a property at the beach, what about that? As far as, is that also considered investment property?
It could be considered a second home.
Second home, okay.
In terms of little
Rates,
bit better.
how does that work?
The terms are a little bit better on a second home than they are in investment
On
property.
investment property,
And
okay.
there's a little bit of a gray area when you buy a second home, because if you buy a place at the beach or the mountains and you're going to occupy it for a certain number of weeks during the year, is it an investment property? Is it a second home? And I think you have to occupy it a certain amount of time as a second home in order to call it a second home.
Oh, really?
And
Okay.
you might want to, that might be a question for a CPA, but
Yeah.
but most people, when they're starting out, if we can call it a second home, we do.
Oh, okay.
Because
okay.
the terms are better, down payment is less, the interest rates are a little bit better,
Right.
and they could occupy it for a few months out of the year and rent it out the rest. So
Okay.
there's some good scenarios for that.
Okay. Okay, going back into the interest rates and calling interest rates, like you were saying, you got a buyer on the phone. A lot of times, potential buyer, what they do is they call a bunch of different mortgage companies basically to find out what their rates are. How does that affect them as far as their credit scoring?
Well,
Because you will need to pull credit to quote them a rate, right?
not necessarily.
No?
A lot of people don't want you to pull their credit.
Right, right. That's what I was thinking.
And,
So you,
and if they don't want us to pull their credit, we don't.
okay.
They have a pretty good idea of what their credit score is, and I can give them a pretty good idea of what the rate would be
Yeah.
if they tell me what their credit score is.
As an educated buyer, yeah.
Yeah. The way the credit system works, you can have multiple credit inquiries
Mhm.
that are mortgage inquiries, and it's supposed to only count as one
Okay.
because the system recognizes that you're shopping mortgage lenders.
Right.
But still, people are very sensitive about their credit score, and they should be. So if they want to wait on pulling a credit report, we do.
Okay.
We have no problem with that at all.
Okay. Okay. You'll still quote a rate based on what they tell you, and
Oh,
I guess
yeah.
you just not hold yourself to it.
As they go through the process, they are soon to realize that the more information that they put forth, the better
Mhm.
off they're going to be. But they might not be ready, and we're not going to push them if they're not ready.
Right. Right. Okay. Okay. Talk to us a little bit. I think you have some special programs for self-employed.
We do. We
Yeah.
do. We have a program where if someone's been, well, even before we get to that, generally to get a mortgage and you're self-employed, you have to have a 2-year history
Right.
of self-employed income. And there is a program through the automated underwriting system
Mhm.
that allows us to use just 1 year's taxes.
Wow. That's
Just
good.
1 year's taxes. They have to be self-employed.
Is
for,
that new?
Not really.
No? It's
No,
been out?
it's
Yeah,
been
because
out
I
for a
always
while.
thought it was 2 years of, self-employed income.
Yeah, it's they have to be self-employed for 5 years, but if they've been self-employed for 5 years
Mhm.
and they had a down year in 2017 for whatever reason, we can just use 2018.
Okay.
And the automated underwriting system will just call for the most recent 1 year's taxes. And I get calls from people right before they're getting ready to file their taxes, and they're like, Steve, how much do I need to declare? Because I'm getting to
That's true.
file
I
my
could be able-
taxes because I want to buy a house
Buy a
next year.
house,
And I'm
right.
like,
Yeah.
I don't know. I got to run the numbers for you.
Supposed to do the right thing, right?
Well, I mean, it's
Yeah.
perfectly okay.
Yeah.
But that's,
I don't want all these deductions because I need to buy a house. What do I do? Do I do all the deductions and not buy a house, or
it's true.
What's more important? Yeah.
It's true.
Any other special programs you want to mention?
We do a lot of work with first-time home buyers.
Yeah.
We do a lot of work with self-employed people. The renovation financing is big. Those are pretty much.
Pretty much it. Yeah.
There's most lenders match interest rates,
Mhm.
so.
Are you doing closing cost help right now for refinancing?
There is lender paid closing costs.
Okay.
There is one other program that we can mention. In a competitive real estate environment, which is what we're in, there's the nice properties. The sellers spend a lot of time and money fixing them up, and they're listed at the high end of what the appraisal market is going to support.
Okay.
So buyers that need closing costs can't ask the seller to pay closing costs because they can't raise the price anymore.
Right.
And if they don't have closing costs, they might be priced out of that market. But
Mhm.
there is a program. There's a line item on the settlement statement. It's called a lender credit, and very often you'll see a few $100s here or there where the lender is gonna pay closing costs, some of the closing costs, but there is a program that we have where instead of asking the seller to pay the closing costs, we can ask the lender to pay the closing costs.
Oh, that's good.
So
that's
instead
interesting.
of 3% from the seller, we can come close to 3%
That's great.
from the lender. And of course the rate's higher,
Yeah.
but we ask that what happens is the buyer comes back, you know, in a few months and they refinance and they get the lower
They can
rate.
get the lower rate.
Yeah.
Wow.
So and they never have to pay it back to lender credit, and that can, you know, 3% on a $400,000 property is $12,000.
Wow, that's a lot of money, and that's definitely worth it. Yeah, doing it that way. Wow. Well, just like that, we're out of time.
Oh wow, it's fast 30 minutes.
Yeah, but we're not doing an hour. Yeah, but thank you so much for being with us today.
Thank you for having me.
And you're very welcome. And we will be back here next week from 1:30 to 2 o'clock. We'll see you then. Have a great weekend, everybody. Have a great week, and we'll see you soon. Bye-bye.
Thank you. Bye-bye.